Hey guys, TommyBryson here, and today I want to find out exactly the 3 main types of investors and which one is best for you. Now, if you're brand new to investing, you probably heard about, hey, speculation, short-term investor, long-term investor, value investor, intrinsic value investor, and you're probably confused, but in reality, all those types of investors actually fall under 3 umbrellas of investing, and that's what I'm going to break down today in this video right here. Whether you want to be like Warren Buffett, like John C. Bogle, an index fund investor, or for example, a day trader or a Bitcoin investor, this video is perfect for you. Now, the first thing is this, guys. If you guys are new here, subscribe to the channel and hit the bell so you're notified. I post every single day. Now, the first type of investor is actually the firm foundation theory of investing, okay? And for example, whenever you hear, oh my gosh, long-term investor, value investor, intrinsic value, business assets, and calculating the entire value of the business, this is exactly what firm foundation theory actually is, and how it comes together when you talk about Warren Buffett, or basically a person that invests based on the entire value of the company and not just on the price of the entire stock at that moment right now. Now, the core idea is that basically what you're doing is you're investing into a company, into a stock, based on its business assets, also its potential growth, but you're not investing based on the price. In reality, you care about what its real price is based on what it's actually worth and its actual value with its assets, and also how much money it actually does produce. That's the entire idea. So when you talk about, hey, it's going for this price, that doesn't really matter that much unless you get in a discount, but in reality, it's all about what is the actual business actually worth. Not about the price of the market, because basically the price is influenced by supply and demand, and sometimes stocks can go up beyond what they're actually worth, and that's why Firm Foundation basically lays on the true value of the actual investment you're actually putting your money into. Now, here's how you actually apply this in the real world when it comes to investing, okay? If you want to be a firm foundation investor, the core idea is that basically what you want to do is you need to learn how to value a business, also its assets, its liabilities, and how much money it makes, and also its potential growth, and on top of that, compare it to its competitors and see exactly the edge it actually has. And that's why sometimes it's so difficult to go out there and basically value a business. So when you actually do this, okay, you're not going to be all over the place. For example, in the car industry, in the tech industry, in the banking industry, usually you're going to pick one industry, learn about it the most, and then learn exactly how to value those businesses, and then go ahead and start investing based on that entire theory that you actually come up with. Now, for example, whenever you look at Warren Buffett, his main investments are usually into the financial industry. For example, banks, insurances, and everything else he actually invests into, that's like, you know, small stuff in a sense, comparative to how much money he makes from insurance, and also by investing into banks and everything else that he actually does, okay? So don't really think about like, hey, I need to go into tech, into travel, maybe airlines, or for example, into any other industry out there. The idea is you need to learn an industry in and out, and then become an expert at it, and then learn how to value those businesses, and then buy the share price at a discount. And that is what a firm foundation theory of investing actually is. Now tell me, what do I need to learn to basically go out there and do this? The answer is you're going to need 2 main skills, and those 2 skills are basically accounting skills to understand the financial books of the entire company, and also finance skills to basically project into the future what that company is going to do based on growth and also income potential. And that's the idea. Now, to do this, you probably are not going to learn this in college, or for example, even for example in high school. I doubt it. But the answer is what you want to do is you want to read 2 books. And the first of those 2 books is basically The Intelligent Investor by Benjamin Graham. And this one is actually an expanded edition. But this one right here, this book is going to teach you exactly how to go out there and value a company. Although it seems long, it is around how much, like 500 pages, but you can read it like around like a week or so. The answer is when you read this book, I want you to have, for example, a pen or a highlighter and practice all the formulas they give you, so that way you understand exactly what they're actually teaching you. The second book is called The Little Book About Common Sense Investing by John C. Bogle, and that book right there is going to teach you everything basically about index funds and how to actually go out there and invest into index funds if you want to be more passive when it comes to your investment strategy, okay? Now, again, I have a link down below to Audible. When you sign up for Audible, you get 2 free books, and even if you cancel, you still get to keep those 2 books. So again, link down below. That way you can get these 2 free books basically for free and read them and learn everything without paying a single dollar. Now, the second type of investor is basically the castle in the air theory. Now, you probably never heard about this one right here, but you have heard about, like, basically, hey, this company is solid. The price is going to keep going up, and on top of that, everyone is investing into it, so you might as well invest right now before it is too late. And that is what the entire idea is when you come to, hey, what is the castle in the air theory of investing? Now, the core idea is very simple. What you're doing is basically, you're not just investing into a company or into a stock, into a business, or for example, into a bond. What you're doing is you're looking at the crowd and the people and imagine exactly how they're going to react to an investment, and you're going to go ahead and basically invest before them usually, or while everything is hot, and then try to get out before everything goes to boop, right? Before everything just goes like bomb, right? Because basically things go up, 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 and before you know it, things go down, 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 down. Every single business is gonna have an up, and it's always going to have a down also. But your whole goal is going to be to look at people and see exactly what they're into, and then buy in before they actually buy in, and then ride the wave and get off right before it actually crashes. And if that sounds basically kind of like impossible, the answer is it is very difficult, and that's why only a few people actually do this successfully. Now, here's how you actually apply this in the real world, okay, guys? For example, right now, Tesla and, for example, pharmaceutical companies are actually hot right now. Everyone says, hey, everyone is investing. These industries are going to change everything, so you might as well buy in right now, because if you don't buy in right now, you're going to miss out big. And as an investor, what you're doing is basically you're looking at the crowd. Everyone wants to buy Tesla, and everyone wants to buy the pharmaceutical company that's probably going to make the vaccine. The answer is all this is kind of like, in a way, speculation, but you're more observing not just the company, but more the people, and looking for signs and cues to when those people are going to lose interest and are going to like bounce and like take all their money out, which then the demand is going to go down and supply is going to go up, which means it's going to become less valuable, and you want to get out very quickly. And that's your whole goal as the castle in the sky theory. And you see this a lot in Wall Street when basically they invest into companies based on what everyone else is investing into, okay? So keep that in mind. Now, Tommy, what do I need to actually learn how to do this right here? The answer is you're going to need to read 2 books. These 2 books are basically, the first one is The Art of Speculation by Philip L. Garrett, and also A Random Walk Down Wall Street. Okay, now that book right there is going to help you a ton understand exactly all of these theories and how they actually work. But if you ask me, this one by far is the scariest, because in reality, you never know exactly what a person or a crowd of people is going to do. And the minute things go down, it will go down, and you will go down crashing unless you jump right before everything goes kaboom. And that's the idea of the castle in the sky theory of investing. Now, the last one is basically, this one's a little funny, okay? But this one is called A Sucker is Born Every Single Minute Theory. And by the way, this is a legit investing theory. Now, if you ever heard, for example, hey, you want to buy now and you want to buy really, really low, and then you want to sell high in the future, and on top of that, you're going to get massive money for your money, and you can basically double your money very quickly. Well, this is what the sucker is born every minute theory actually is. And you might think, Tommy, this sounds like a scam. In reality, you do have a lot of scams in this entire like idea right here, but it is a real one, and I will break it down right here, okay? Now, the core idea is that basically what you're doing is you're investing into something with the idea that someone else is going to pay more for what you just bought, and that's the whole idea. So basically, you're investing always trying to buy low and sell high to someone else, and that other person is the next sucker, and that's why they call it a sucker is born every minute theory, okay? You buy low, someone else buys it, and that person thinks that, hey, well, I'm gonna buy it now, but then somebody else is gonna go ahead and buy it for a higher price, and that's how you get, well, I'm a sucker, somebody's gonna be a bigger sucker, and then boom, 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 it keeps going up and going up and going up. And that's the entire idea. But by the way, this works great whenever something is very high in demand. But once things go back down, in reality, you will be the final sucker, and you will basically lose a ton, if not sometimes all of your money trying to invest this way. Okay, now, how do you apply this in real life, Tommy? Well, in reality, if you heard about, for example, Bitcoin or all those coins that are popping out right now, it's kind of like the same idea, okay? Everyone is investing into something that doesn't really produce anything, doesn't really have any value, but the idea is that, hey, by the way, I don't think like 90% of people actually invest into Bitcoin. What they do is basically the same thing here, okay? A sucker is born every minute. The idea is that, hey, I'm going to buy low and I'm going to sell high. And basically, sometimes I can always go ahead and basically multiply my money, maybe 2x or 3x in less than a month, sometimes in less than a week. And that's the whole idea. So in reality, it's very, very speculative. And it's also very, very risky. Now, I recommend you read a book called I Will Teach You to Be Rich by Ramit Sethi. Now, this book right here is going to teach you exactly how to invest money into this stuff, but not all your money, and still go ahead and build massive wealth while still doing this whole thing here of like, hey, I want to basically get rich very quickly, but you're actually getting rich slow and fast in a way, but you're not taking that much risk with this stuff. And the idea is you want to invest into this stuff, yes, but no more than like 5 to 10% of your money, and no more to a place that was actually going to hurt you, because at one point, guys, people literally borrowed money to basically go ahead and invest into Bitcoin. And all you hear is the good stories, but everyone with a bad story basically says, shh, don't tell anybody what happened to me, okay? It's risky stuff, okay? Very, very risky. And overall, if you ask me, Tommy, which one of these theories do you actually like the most? In reality, what I do is I do firm foundation. So basically, I invest based on the value of a business and not based on speculation or, hey, someone's gonna buy for more. The answer is I don't care about that, okay? What I care about is basically what is the value of this business, how much is gonna pay me, and what is going to be my return on my money, and that's the way I actually invest. When it comes to the cash on the sky theory, or for example, the sucker born every minute theory, the idea is there is a lot of speculation going on here, and most people, around 80% of them, are going to lose a lot of money, and the other 19 or 17% of people are probably just going to break even. So you want to be very, very careful when it comes to this stuff, okay? And the idea is this, okay, guys, I could play the game of like, hey, castle in the sky or sucker born every day, and basically I could make a lot of money, but in reality, all the odds are stacked against me. And I'd rather play a game where all the odds are actually in my favor. And by the way, you might say, Tommy, but why do people invest this way? Why do they think that basically they can double their money or triple their money in like overnight or whatever? The answer is, well, in reality, they think that way because basically it has happened in the past also. So it's not like it'll never happen thing. It might happen, but it'll be a very small fraction of people that actually happens to. It's kind of like the lottery, you know, like how one people wins, but then in reality, millions of people actually go out there, spend money and lose money every single day. That's how it works. The idea is that, hey, it happened to them, it might happen to me, so they go ahead and they take the risk, okay? So be very careful with this stuff, guys. In reality, I recommend you read every single book I recommended here, and that way you get the full understanding of it, and that way you decide exactly what you actually want to do. For me, it's all about firm foundation, and also the intelligent investor, and also the little book about common sense investing, to teach me exactly how to invest into index funds, and that's what I do today. Now, if you want to invest like how I invest, I use an app called Acorns and also M1 Finance. I'll put a link down below also to Acorns and also my portfolio in M1 Finance. That way you know exactly what I actually invest into. So comment down below, guys, and let me know, was this video helpful? Did you learn something? And by the way, if you read the book, A Random Walk Down Wall Street, it's going to teach you everything about those theories, and it's going to go into much details with a lot more stories and a lot more examples. I highly recommend you go ahead and read that book, okay? It's called A Random Walk Down Wall Street, and the author is actually Burton G. Malkiel, and I'll put the book right here that we know exactly which one it is, but the answer is a great book, and I highly, highly recommend it. But again, guys, I'll see you guys tomorrow. Thanks for watching. As always, like this video. On top of that, also, subscribe and hit the bell so you're notified. On top of that, also, follow me on TommyBryson. And before I go, if you want to watch a video basically on the basics of investing, watch the video right here. I'll see you guys tomorrow. Thanks for watching, and as always, peace.